So, silver crashed about 30% on the day. We saw a high of about $121 per ounce. And within one trading session, we saw it go down to about $76 per ounce. It's recovered a little bit. Right now, it's trading at about $85. So, it did recover a little bit, but that was the biggest drop I've ever seen. Um, so yeah, I mean the COMEX silver, prices haven't really dropped 30% since 1980. You know, the SLV closed down to 76. Well, we haven't actually closed yet. We still got one more hour, but it's looking like it's holding steady where it is right now. So I don't expect it to move much. It might just grind sideways for now, somewhere around 85. So if you look at some of this volume, we'll see there was tons of selling pressure. There was a lot of selling pressure in the off hours market. Once market opened, we saw even more selling pressure. These were concentrated books. Most of these were, banks, large institutions that are shorting silver, shorting gold. Um, it's the last, it's Friday. It's the last trading session of the month, January. They have a lot of contracts closing today. They didn't want those contracts to close above their levels. So I knew they were going to, try to keep it under. I thought they were going to probably try to keep it to like 112, maybe like 106. I did not know they were going to drop it down below 90. That I did not anticipate. But it sort of makes sense when you think about it. They want to take out retail enthusiasm. They don't want retail to be bidding up the prices. So this is one of the ways they can do that. As you can see, you look at this volume here, just an incredible amount of volume out of nowhere. I mean, if you look, our volume was pretty much normal, and then all of a sudden you get this red candle here. And also, if you look, we've been seeing this pattern before. Look, we saw another one right here. This was on the 29th, right? So we saw another huge spike in sell volume, and we saw that price crash, come down. We saw another one right here, saw that price come down. And then we just saw a sustained campaign of sell volume getting that price down to where they want it. And they've been doing this for a while. I mean, if you look here, you'll see the same thing. Huge spike in sell volume, huge spike in sell volume. I mean, these candles are telling you what the banks are doing. And recently, the Federal Reserve just injected $40 billion or more into the repo market, into these banks. They loaned it to them at a very low rate so that these banks could go in and naked short silver, right? That is, sell paper contracts without actually physically putting up the money, right? They could get 10 to 1 leverage, 20 to 1 leverage. They could take 4 billion, turn it into 40, take 40, turn it into 400, use all that loaned money to, sell paper contracts to suppress the price. They're doing this, they're going to buy it back cheap, let it ride back up, take that profit. They're also going to liquidate you out of your positions as well. So this is what they're doing. This is their playbook. We also saw gold crash from its high as well. If you look, we had some more red candles here, and a sustained campaign of red candles to get that price down to where they want it. Once they got it down to where they want it, below 5,000, they let it ride back up. More than likely, they bought back cheap, right? So we reached a peak around 29th, 825 on Thursday, almost 5,600 for gold. And then you saw this red candle bring it back to where they got it down right here. Some more red candles here, they got it down. And then a sustained campaign to get it down to sub 5,000. And they're going to let it get right back up, right? They're not going to keep it that low. but they wanted to get it low for a few reasons. One is Friday, the last trading day of January. So, they need to roll over. They need to stay profitable. They don't want their shorts positions to get unprofitable. So that's one main reason. The other reason is a lot of retailers taking a lot of profits, right? So they don't really want to give up those profits. So they want to kind of scare retail out. Now, keep in mind, physical is still doing well. You cannot physically buy gold or silver for the price they're quoting. If you go to bullion markets right now, most of these are out of stock, so you can't even really buy them. The ones that are in stock are nowhere near the levels they're asking, right? I mean, they did get it down a little bit under 90, 100, right? So it is a little bit, but we'll see if it holds. As you can see, this 1 ounce coin is still well above 5,000, right, of gold. So these paper prices are not real. You cannot buy gold for that price. You cannot buy silver for that price. You look at the Shanghai price, $20 premium. However, this has not been updated because our price has gone down to 85 right now. So that means the premium is actually about $40 to $50 premium, which is it's never happened in history. Never had a $50 premium. Let's take a look. Take a listen.
$5,000 per ounce. I mean, you just had yesterday morning, it was touching around 5,600. So it's a massive move to the downside. Silver as well, down 13%. Mike McGlone over at Bloomberg is basically saying you may have just seen the top on silver, and this could be for years now that you won't see those same silver prices as you've seen. He's been warning about this massive speed in this rally that we've seen. And we're also looking at other metals as well that are down. I mean, you're looking at copper. Also, copper was up around above 14,000 per ton in London, and that has also moved lower. That doesn't take away from sort of this narrative that we've been hearing about, is the demand for these metals, for the demand for copper that you're going to need for data centers, for electrification, et cetera. But look, there's inelasticity when it comes to that, because a data center is not going to stop being built just because you've got higher copper prices. But nevertheless, a lot of this has to do also with China's speculative trading as well. So analysts had been warning this parabolic move. You can't have these types of parabolic moves without having some type of a downturn at some point.
That's not necessarily true. I mean, she's saying you can't have it go up without it going down. I mean, it's going up for a reason. It's not going up because retailers speculating. It's not a speculation driving the price. Shortages are driving the price. We just had the United States send a lot of military equipment into Ukraine, send a lot of military equipment into Gaza, right? For those two wars, and it's going to take many, many years, if not decades, to replenish those stocks. Now, when you talk about military equipment, what goes into military equipment? It's metal, right? They need metal for the advanced electronics, the guidance systems, for the hardened, ammunitions, anti-tank, anti-shells, all those complicated, advanced military equipment needs metals. So, those military contractors have to buy back those metals right now as they're trying to manufacture and replenish those supplies. That's driving up costs. You also have central bankers, BRICS alliance, currency wars. Those are driving up costs as well for metals. And you also have data centers, AI data centers. They're buying years worth of electronics in advance, memory, chips, coolers, power supplies. They're building out massive amounts of data centers, which is driving up metals, because all of those data centers require lots of copper, lots of silver, some amounts of gold. So, yeah, it's going to drive up costs. So this is not a speculation driving up costs. What is speculation is driving down costs. Those are future contracts. Um, Here we go. Precious metals crash with silver plunging 35%, gold falling 12%, Bitcoin holds at 83. The bubble in precious metals might have popped with silver violent decline. Again, they're calling it a bubble. It's not a bubble, it's a shortage. Having touched 120 an ounce. Now, I don't think we're going to get back below 120 after this situation. I think once we get above 120 again, we will never get back below 120, right? You have to keep in mind it gets more expensive for them to keep these arbitrages, right? Because the physical metal is not ever really going to go back, right? Shanghai is not going to drop their prices because they're not speculating on the metal. They need the physical metal for their industries. So I don't think you're really going to get it going back below 120. I don't really think you're going to see gold going back below 5,000, except for this one-time event, this liquidation event. I don't think it's really going to go back down below these levels again. So January might be the last time we touch those levels. That's my opinion. And another reason for that is these are the CME month-to-date delivery notices, right? So basically what's happening is you have cumulative delivery notices. You got about 10,000 contracts by as of yesterday. These are 5,000 troy ounce contracts. So 5,000 times 10,000, that gives you about 50 million ounces of deliveries. So metal is leaving the vaults, right? Metal is leaving the vaults. They're running out of these metals. So, another reason you might see them smash these prices down is so that they can settle metal for cheaper, right? If they owe you, say they owe you like $50 million worth of metal, and they smash the price down by 30%. Well, all of a sudden, they only have to give you 70% of what they owed you in terms of metal. So that's another reason why you would see them smashing prices down, to help them to get it out at a cheaper price, right? Because people are actually physically asking for delivery. So I'm still bullish on metals. I'm still bullish on silver. I'm still bullish on gold. You might see some temporary volatility, like I've been saying. They're going to keep these prices low, but always look to physical to see the real price. You cannot get gold below 5,000. If you want to get silver, right now, you can't get it below 100. I mean, I do see like 97-ish, right? Just slightly, but basically it's $100 for silver, 5,000 for gold. That's not changed for physical. And if you look here, this is telling you 84, but this is telling you 197 to 100. So, or maybe 95. But look, even here it's saying 95. They're saying you have to wait till Feb 5th to even order this. So this that's not really the price. That's not really the price. But yeah, I'll keep you updated on the price movements, and just if you're trading, stay careful. Keep in mind that the banks they're going to continue to do this. So do not go all in. Always hedge. Throw in some put contracts. Go ahead and take profits early. Don't wait. If you're going to reinvest, try to reinvest some percentage that you're prepared to lose, right? If you're up, let's say you're up 100%, maybe only invest 50%, right? Don't take all the money you just made and reinvest it when the market is so volatile. But that's my update. I'll keep you posted on any more price action. Have a good one.